to the deep dive. Today we have 7 high-impact pieces of financial research, and our mission is to boil them down into the most urgent insights for you.
That's right. We're going to connect the dots here from Fed policy and housing to, some really big risks in the tech sector.
So we'll just go source by source. Let's jump right in. Where are we starting?
Let's start with the central banks. Our first source is called normalization.
Okay, normalization. We've heard the Fed is backing off its tight policies.
Yeah, but the devil's in the details here. They're ending quantitative tightening, or QT. But, and this is the key part, they're now buying T-bills with the money from maturing mortgage-backed securities.
Which is a kind of QE, right? A euphemism for QE is what the source calls it.
Exactly. It's a technical maneuver, but the result is simple. More dollars are being injected into the system.
And more dollars usually means more inflation risk?
It could lead straight back to it. We might even see a return to those aggressive rate hikes from 2022.
Wow. And that inflation isn't just a risk, it's already showing up. That brings us to our second source, CPI pressure. Private measures of inflation are ticking up again. The 4-month average for CPI is pointing to a 4% price increase.
4%. That's double the Fed's target. It's a huge number, driven by tariffs and, frankly, just sustained government spending.
So the Fed is caught.
They're in a classic dilemma. A rate cut, which markets are still pricing at a 45% probability, could just pour fuel on stocks and inflation.
But if they do nothing,
then they risk higher unemployment. There's really no easy way out for them.
And that pressure, it isn't abstract. It hits people directly, which is a perfect transition to our next source, affordability.
This one is just stunning. Housing affordability is cratering, and the data point that really stands out.
I think I know which one you mean.
The average age of a first-time home buyer is now 40, an all-time high, 40 years old.
Wow. And the proposed solution is almost as unbelievable.
The 50-year mortgage. It lowers your monthly payment, sure, but it massively increases the debt you carry, and for how long?
So we're just piling more government-guaranteed debt onto the, $38 trillion we already have?
That's the playbook. Solve a debt problem with more longer-term debt.
This idea of a circular economy of debt.
Yeah.
It's really starting to take shape. Let's follow the money. Where's all this capital going? Let's talk about source 4, give and take.
It's flowing right into tech. You have the Magnificent Seven, the massive build-out for AI. It all requires huge amounts of capital and energy.
And they can't fund it all themselves.
Not even close. The source says their organic cash flow is about 50% short of what they actually need. 50%.
They have to lever up. The biggest companies in the world are borrowing heavily.
Right. And that's extending the risk. It's not just in their stocks anymore. It's moving deep into the credit markets.
Which brings us to all in on AI, because bond investors are starting to notice.
They are. The cost to insure against default for these big tech companies, their credit default swaps or CDS, it's rising.
So little warning sign is flashing.
A definite warning sign. It's driven by that huge need for cash and, some pretty aggressive accounting practices around depreciation.
Okay, so we have leverage risk. What about just outright valuation? That brings us to negative risk premia. This sounds technical, but it's a big one.
It's a huge one. The risk premium, which is basically the S&P 500's earnings yield minus the 10-year Treasury yield, it just went negative.
And in plain English, that means?
It means for the first time in a while, bonds are offering a better value proposition than stocks. It's a clear signal that equities might just be too expensive right now.
Overly expensive.
Yeah.
Got it. Okay, one last piece. Let's look where things get really murky. The private markets. This is marking the market.
Yeah, this source looks at how private funds value their assets. And when the market is stressed, things get subjective.
How subjective?
We're talking a 14% price spread on the exact same loan held by different private credit managers.
14% for the same asset?
Exactly. It just shows you the danger and the hidden illiquidity risk when no one can agree on what something is actually worth.
So let's pull all this together. We have central banks creating money, housing propped up by subsidized debt, and the biggest tech companies leveraging up like crazy.
It's all connected. The sources paint this picture where the key parts of our economy are all becoming more and more reliant on either subsidized debt or, these very questionable valuations.
It really is a circular system, which leaves us and you with one final thought to chew on. Both the AI boom and our solutions for housing rely on more government guarantees and more leverage. So the question is, how much more debt can this circular economy actually pile up before the whole system reaches its limit? Something for you to think about.